Good evening, and thanks so much for tuning in. This is BQ Prime, and this is, in fact, the last edition of the Mutual Fund Show for 2022. Now, the end of the year is viewed with exuberance quite a few times, and this is because of what the new year promises. But it's also a time of reflection. You look back at the year that's gone by, and you look at the year that has come and prepare for what it has in store for you. To that end, let me introduce my guests for today. We've got Nilesh Shah of Kotak KMC, and we've got Feroze Azeez of Anand Rathi Wealth. Thank you so much, gentlemen, for taking the time. And let me start by wishing both of you season's greetings and the best of prosperity in the new year. I want to start with you. Nilesh Bhai, just to get a sense and to set the context for this conversation. Where do we stand here in India? What is the global context for financial markets? And how do we, from India, look at the global picture?
So today, it will be fair to say, Alex, that global situation is fairly troublesome. They had funded revival or growth during COVID time through excessively loose monetary policy and fiscal policy. Now, those steroids are being withdrawn and the weakness is visible in the economy. In that overall global context, India is relatively in a better position. We do have chinks in our armor, but compared to the world, we are in the better position. I'll give you some data about India. In CY22, 6 out of top 10 fastest growing cities in the world are in India. Mumbai, Delhi, Kolkata, Chennai, Hyderabad, and Bangalore. Today, we have spent about $130 billion for deficit and FPI outflows. And yet, we have the 5th largest foreign exchange reserves in the world. Our inflation, by and large, in 2021 is higher than RBI's comfort level. And yet, for the first time in our history, it is lower than American inflation for more than a year. So on a relative basis, Indian economy is doing well. The world situation is fairly green. And clearly, we have a challenging time ahead.
Okay, so that sets the context, I think. And Feroze, I think a lot of my viewers will want to know also, with what we've just discussed and what Nilesh just pointed out, how does the retail investor approach 2023 from an overarching frame of mind? And then we'll delve a little deeper.
So I think a retail investor needs to respect all the risks, not just get carried away with one risk, because some of those risks are optically visible. Some of them are camouflaged risks, especially when we speak of inflation so much over the last 6-8 months, globally from a global context perspective and Indian context perspective, and having large amounts of debt or debt-related instruments, which is what we are the third largest economy from a savings standpoint, household savings standpoint. But when you look at the savings, are they being as productive as they could be over the last couple of decades? If you reflect back, that's where we've gone wrong. We've gone right in extent of saving. We've not transformed those savings into right investments. I think that's one thing we should correct in this subsequent years. That's what a retail investor should think of. The second thing he should think of going forward, that he should not look at the rear view mirror as much. If you look at the last 4-5 instances of people buying performance, they've gone wrong in 2020, be it the NASDAQs of the world, be it those cryptos, be it unlisted stocks, you name it, you would see that people have the tendency of buying past performance. That's one key learning we take back from 2022. Now coming to looking forward, I think all 4 assets which are there are relevant to each individual at a point in time. Not falling in love with one of them is the key investor attribute we should aspire for. Like people, I meet several people in the marketplace. Somebody who's fallen in love with FD, he will be with an FD for all his life. If somebody's fallen in real estate, irrespective of what the cycle is, they will stay with the course. So these 4 assets, all of them have some importance in this year. Unlike most of the past years, all 4 could have some weightages. is the first point I'd make. And equity, of course, from an Indian standpoint, would be the key asset class to build for the retail investors, and they're doing a great job. Let's not take away the credit. The SIP numbers moving from 11,900 in April to some 13,500 is a great representation of an informed retail investor
Yes.
During the most volatile times.
Absolutely. And in fact, I think that household savings point, Nilesh has also made that point in the past. Out of the total quantum of household savings, Nilesh, not a very large portion still, despite the higher contribution, goes towards equity. So let's talk about equity and let's talk about the investor in equity markets. It's hard, as you pointed out several times, to give an outlook, particularly for the equity market in the new year. But having said that, what are the key trends that you see playing out over the course of 2023, and how should the retail investor position themselves to best take advantage of those trends?
So one, our equity market are discounting most of the positives which are visible today. That means we are like Surya Kumar Yadav. When we go to bed, people expect you to hit fours and sixes. People expect you to score a century.
Yeah.
So please remember that in 2023, India will have to deliver on the higher expectations. Number two, globally, there are many events which will hit India or shape India. Russia-Ukraine situation, Fed pivot, OPEC cartelization influencing energy prices. These are all the global factors which will continue to weigh on Indian economy as well as market. If these factors come favorably, we will do well. If they don't come favorably, we'll invariably have to have some correction. The third and the most important thing which matters for us is the longer term horizon. Equity market is like a test match. You don't come here to play 20 overs. You come here to play 200 overs. 2023, like 2022, will be a difficult year to make money because positives are priced in and there are so many events waiting to happen. In this kind of scenario, it is more of a buy on the dip market. Use correction to increase your weightage to equity as an asset class. Be a long-term investor and have moderate return expectation. This will come handy for investors as they navigate choppy waters of 2023.
Well put. I think to pull that a little forward, Feroze, from the advisory point of view, in conversations that you have, I'm sure that you stress the importance of asset allocation. You spoke about that in the first question I asked you as well. So I'm going to pose this question a little differently. Assume that there is a new investor that is deciding to invest for the first time in January of 2023, or in fact, you have someone who has had the advantage of the last 3 years and is now at a position where they need to study their portfolio and rebalance. How do they approach the equity investment side of their asset allocation strategy?
Yes, Alex, like you said, there are different kinds of people, and there's no one size fits all. That's what personal finance, the personal word there, emphasizes it being a very customized kind of situation which we all experience. Now, let me just pull one word from what Nilesh Shah was saying: expect moderate returns. I think if you're a new investor, the first thing is to understand the asset class you're dealing with, right? So you have to see that you have moderate expectations. People have very, very steep expectations with equity. They have very relaxed expectations from real estate, for example. Right? I met a gentleman. He says, I like to see my statement on the 3rd of every month on the financial side. I said, sir, when was the last time you calculated the IRR of your second home? He says, I've bought it 22 years back. I've never calculated the IRR. But the same human being wants to see the financial assets portfolio IRR on a monthly basis, not later than 3rd. This behavioral finance aspect of putting one of them under tremendous pressure. You want equity to come from class 1 to class 10 as a child in 2 years. real estate gets 10 years to become a 10 standard student. So don't put too much pressure on one asset. Second is, before you begin, always remember when you're cutting the check into equity, that equity markets average have fallen 20% from peak to trough every single year. Even if you remove the two exaggerated years of 2008 and 2020, 14.3% is the fall from peak to trough. So don't go looking for reasons why market will fall. Market will find their reasons. You have to decide what you wish to do when that happens, rather than just go around trying to find out the reason. This is just some foundation piece of advice because you said it's a beginner. If it's a beginner, I would assume that he or she is beginning under 30 or under 35 at least. I would say 80-20, 80 into equity, 20 into debt, assuming that you have enough gold in your lockers and you have real estate, which are large ticket items. Only that portion, 80-20, can give you 11-12% kind of a post-tax return in the current regime, with both these financial assets are very, very lucrative. Debt is giving you 6.5% post-tax lending to central government. You're getting 13-14% in active funds is possible.
Absolutely. And that, I think, very neatly brings us to the next asset class, Nilesh, which is the fixed income side. We've seen 5 rate hikes to the extent of 225 basis points in India. And globally, the perspective, of course, is that the Fed is not necessarily done with its hiking scenario. And what does India then do, or the RBI do in response to that? It will also have to, in some way, though it looks at the India perspective, react to that global changing environment. So what is the outlook for the debt market? Would you say that it's a great opportunity to lock in for the slightly longer period, given the rates right now?
So, Alex, today, globally, many people believe that Fed will keep rates higher for longer. Many people believe that Fed will have no option but to lower the interest rate, as the debt burden will kind of squeeze out the economy. I'm in the camp that Fed will not be able to keep rates higher for longer, because the debt servicing of American economy, American consumer, and American corporate will go for a toss if Fed continues to keep higher interest rates. Keeping that in background, today market consensus is that by March, April 23, Fed will reach its peak interest rates at about 5/4. And by September, October 23, they will start cutting interest rates. RBI will obviously follow the Fed. They will raise smaller steps of interest rates on the way up. They'll cut interest rates much later, but they will be following Fed in setting India's monetary policy. Now, from an investor point of view, my recommendation will be wait for the budget. We will see the borrowing program. Last year, banking liquidity was around 8 lakh crore, and the borrowing program came at about 11.5 lakh crore. This year, banking liquidity is about 2 lakh crore. And if the borrowing program comes at 13.5 lakh crore, I don't think so markets will have appetite for this borrowing program. And there is possibility that yields may back up a little higher. Post-budget, when yields are, let's say, 7.5 and above, that will be the time to lock duration. That will be the time to go for longer duration. Now, many people say, we really won't have time to manage all these things. Fair enough. Then you can invest in dynamic bond fund, where fund manager can manage duration looking at interest rate movement. But I think the time to invest in debt, especially longer duration, will be post-budget.
Fantastic. I'll circle back on the budget in just a bit, but Feroze, on the, and you've already pointed out on the fixed income side. So I want to ask a slightly different question. 225 basis point increase in the policy rates, as I mentioned. Now, when it comes to a home buyer, this is actually something that is flipped very quickly in a matter of less than 10 months. You were able to get a home loan at sub 7%, and now you're touching close to 9% on that home loan. If you have got a home loan, what should your strategy be? Should you look to pay quickly if you have the appetite to do that or capability? And if you are possibly thinking of buying a home at this juncture, should you put off that purchase just a bit and utilize this time to save and increase your down payment?
Yes, Alex, point one, I think home buying is more of an emotional aspect for the first home which you're going to live in. So I also personally think that that's a great utility of money because it brings you calmness in life. It brings you more joy. You can do what you wish to do with your home, which you can't do with a rented house. So I think home buying is not a bad idea. Coming to your point of interest rate movements upwards, I think till date people can borrow at 8.25 on a home loan basis. You're speaking about Government of India borrowing 10 years at 7.3, 7.4, and there are some MNC banks which are ready to lend a home loan at 7.75, even 7.5. I've heard. So you're with an individual credit risk. You're speaking of borrowing at very similar rates or marginally higher than Government of India. So that kind of policy rates have not been passed on to the client. Point one. Point two, I think policy rates take a lot of attention of both the investor and the borrower. And I think investors never make money or lose money on policy rates. They make or lose money on 10-year yields or 5-year yields of bonds and the spreads which the corporate bonds command over the GSEC paper. So point two I'm trying to get to is, today is still a good time to buy a home, provided it comes in your budget. There are 4 or 5 other ratios which are very critical when you buy a home. You have to look at your EMI to your disposable income ratio. You have to look at your portfolio to your EMI ratio. If you look at those 3-4 ratios, have a thumb rule that you're not going overboard. The more important decision is not going to be whether you're going to be charged 0.25% average more during the life of the loan. Then what time are you qualified to buy a home today? Don't stretch too much.
What are those ratios very quickly? What are those thumb rules?
Yes, so let me touch upon 2 of them because the value to the viewer would be for me to speak less and let Nilesh Shah speak. So I will just touch upon 2 of them and we'll keep the topic for the next another day. One very important thing is if you're buying a down payment, if the down payment of your house is greater than 50% of your current portfolio, I'd say no, you please accumulate more assets. Sometimes what happens is people give a down payment of 30 lakhs, but their portfolio was 35 lakhs. That's not. You maximum can give a down payment of half your portfolio size. That's point. Point 2, your EMI for home loan should not exceed 40% of your post-tax salary credit. These are, of course, very broad, but at least instigating a thought to the viewer.
Absolutely. Nilesh, I kept this for the end because I think there's going to be a lot of interest over the coming month or so on what really is going to happen in New Delhi on the fiscal policy side. Budget, of course, is around the corner. 2 things. What are your expectations and what do you think should be done?
So, Alex, my expectations will be that India should give a fiscal roadmap towards consolidation. Thanks to COVID, we had to keep FRBM in abeyance, but we should not abandon it. That means we have to give a roadmap to reduce our deficit. Now, deficit can be reduced in 2 ways. One, raise resources or cut spending. In today's environment, I don't think so it will be wise to cut spending. Yes, of course, if we can maximize the output from limited spending, that will be always better. Increase the efficiency of spending by removing wastages, by removing leakages. But we must continue to spend so that the economic momentum continues. The option is to raise resources. Now, one could raise tax revenue or one could raise non-tax revenue. On the taxation side, we have to plug the loopholes. We have to ensure that some of the loopholes which are available are plugged so that the burden of taxation gets distributed equally over all the citizens. There are a couple of avenues which government should consider for raising resources. Between 2017 to 2021, 930,000 Indians have surrendered their citizenship. And if they are taking away probably, let's say $250,000 over a period of time, that's an outflow of $250 billion. We must ensure that this outflow is discouraged. By levying an exit tax, when an Indian citizen surrenders their citizenship, they have to pay an exit tax. United States of America levies exit tax, and so do many other developed countries. Levying exit tax will, one, raise resources for government. Second, it will discourage capital outflows. So that's one way to manage it. The second thing, my recommendation will be gold disclosure scheme. In 21 years of this century, we have imported close to $373 billion of gold on a net basis. We all know gold smuggling is flourishing in India, thanks to about 15-16% import duty differential. If we add gold smuggling, then this number could be as high as $500 billion. But this capital is locked into Tijori and bank lockers. It is not there in white economy. By structuring a gold disclosure scheme, government will raise revenue. It will also free up capital, which can then go and invest in white economy. So you have to raise resources through non-tax manner, which allows you to fund your spending on infrastructure and which encourages growth. At the same time, keep fiscal discipline. If you can achieve this impossible trinity of raising resources, spending money, and maintaining fiscal discipline, I think budget will be a watershed budget.
Absolutely. On that note, gentlemen, thank you so much for taking the time. Always a pleasure speaking to both of you. And once again, wishing you a very prosperous 2023.
Thank you, Alex.